Hello, welcome to the Ninth Ocean Crypto. On this channel, we will talk about all things crypto, blockchain, NFT, decentralized finance, metaverse, and much more. We focus on providing valuable information and education to our viewers as we firmly believe that cryptocurrencies and blockchain technology will be the future of our economy and business. In this video, I am going to talk about the basics of history of cryptocurrency as well as how to make money using cryptocurrencies and NFTs. So, I will be sharing some crucial information that you must be aware of in order to succeed in your endeavor in this market. So, watch every minute of this video because you don't want to miss any of the important information I will be going over. Make sure to hit that subscribe button, and if you haven't already, and feel free to like and leave a comment down below. So now let's get into the video. The first thing is, what is cryptocurrency? Cryptocurrency is a digital payment system that doesn't rely on bank to verify transactions. It's a peer-to-peer system that can enable anyone from anywhere to send and receive payments. Instead of being physical money carried and exchanged in the real world, cryptocurrency payment exists as a purely as a digital entries to an online database describing specific transactions. So when you transfer cryptocurrency, funds and transactions are recorded in a public ledger and cryptocurrency is stored in digital wallets. Cryptocurrency received its name because it uses encryption to verify transactions. This means advanced coding is involved in storing and transmitting cryptocurrencies data between wallets and public ledgers. Encryption aims to provide you safety and security. That's why cryptocurrency is also safe. And the cryptocurrency was first mentioned in 1989, and a few years after, in 1980, American cryptographer David Cohn invented digital cash, which relied on cryptography to secure and verify transactions. But it was only in the early 1900s that cryptographic protocols and software began to be developed that would make possible the creation of truly decentralized digital currency. In October 2000, a paper by Satoshi Nakamoto, a pseudonym titled Bitcoin, a peer-to-peer electronic cash system, outlined a system for creating a digital currency that did not require trust in any third party. Nakamoto's paper effectively launched the cryptocurrency revolution, and the first cryptocurrency was Bitcoin, which was founded in 2009 and remains the best known today. Much of the interest in cryptocurrency is to trade for profit, with spectacular at time driving prices skywards. And there are thousands of cryptocurrency of the best known, which includes like Bitcoin, Ethereum, Dogecoin, and many others. So let us understand how does the cryptocurrency work. So cryptocurrency are run on a distributed public ledger called blockchain. A record of all transactions update and held by the like currency holders. So units of cryptocurrency are created through a process called mining, which involves using computers power to solve complicated mathematical problems that generate coins. And now we know that generated coins. So if you own a cryptocurrency, you don't own anything tangible. What you own is a key that allows you to move a record of a unit of a measure from one person to another without a trusted third party. Although Bitcoin has been around since 2009, cryptocurrency and applications of blockchain technology are still emerging in financial terms, and more users are expected in the future. Transactions include bonds, stocks, and other financial assets could eventually be traded using the technology. So now the next thing we are going to discuss is cryptocurrency safe? So cryptocurrency are usually built using blockchain technology. Blockchain describes the way transactions are recorded into blocks and timestamped. It is fairly complex technical process, but the result is a digital ledger of cryptocurrency transaction that's hard for hackers to tamper with. In addition, transaction requires a two-factor authentication process. For instance, you might be asked to enter a username and password to start a transaction. Then you might have to enter an authentication code sent via text to your cell phone. While securities are in place, that does not mean cryptocurrencies are unhackable. Several high-dollar hacks have caused cryptocurrency startups heavily. Hackers hit CoinCheck to tune like 534 million and BitGrail for 195 million, making them two of the biggest cryptocurrency hacks of 2018. Unlike government backed money, the value of virtual currency is driven entirely by supply and demand. This can create wild swings that produce significant gains for investors or big losses. And cryptocurrency investments are subject to far less regulatory protections than traditional financial products like stocks, bonds, and mutual funds. The basic terminologies in cryptocurrency in the crypto world is that crypto is a word on its own with different terminologies and language that help those in it to understand themselves. I believe that you are reading this book means you are already part of them. In that world, you are going to probably be. So we will be discussing the terminologies used by mostly by all the crypto experts and what they mean. Knowing these terminologies, we will make their language clearer to you. Blockchain. Blockchain is one of the most used word in the crypto world. I can say that understanding how the blockchain works means you have understood the basic concepts of crypto. A blockchain is a distributed database that is shared among the nodes of a computer network. As a database, blockchain stores information electronic in digital form. Blockchains are best known for their crucial role in cryptocurrency system, such as Bitcoin for maintaining a secure and decentralized record of transactions. The innovation with the blockchain is that it guarantees the fidelity and security of a record of data and generates trust with the need of for a trusted third party. A database usually stores it like data into table, but a blockchain, like its name implies, stores its data into chunks of blocks that are strung together, and this data is stored inherently make it like irreversible timeline of data. When implemented in a decentralized nature, when a block is filled, it is like set in a stone becomes a part of its timeline. So each block in the chain is given an exact timestamp when it is added to the chain. The main purpose of blockchain is to allow digital information to be recorded and distributed, but not edited. In this way, a blockchain is foundation for immutable ledgers or records of transactions that cannot be altered, deleted, or destroyed. This is why blockchains are known as distributed ledger technology (DLT). This means that all the transaction history that ever made since the establishment of crypto is heavily stored on the blockchains and can never be altered by anyone. This is a great advantage of crypto that our fiat currencies and bank can achieve. Now, this concept of blockchain promotes transparency and safety because of its decentralized nature. All the transactions can be transparently viewed by either having a personal node or using a blockchain explorer that allows anyone to see transactions occurring live. Each node has its copy of the chain that gets updated as fresh blocks are confirmed and added. This means that if you wanted to, you could track the Bitcoin wherever it goes. For example, if any exchange platform is hacked as they have been in the past, but those who kept Bitcoin on the exchange lost everything. While the hacker may be entirely anonymous, the Bitcoins that they extracted are easily traceable. If the Bitcoin is stolen in some or of these hacks were to be moved or spent somewhere, it would be known. Of course, the records stored in the Bitcoin blockchain as well as most of the others are encrypted. This means that only the owner of the record can decrypt it to reveal their identity using a public private key pair. As a result, user of blockchain can remain anonymous while preserving transparency. One of the most common asked question asked by the newbies in crypto is how safe the blockchain is. So the blockchain technology achieves decentralized security and trust in several ways. To begin with, the new blocks are always stored linearly and chronologically. That is, they are always added to the end of the blockchain. After a block has been added to the end of the blockchain, it is extremely difficult to go back and alter the contents of the block unless a majority of the network has reached a consensus to do so. That's because each block contains its hash along with the hash of the block before it, as well as the previously mentioned timestamp. Hash codes are created by a mathematical function that turns digital information into a string of numbers and letters. If that information is edited in any way, then the hash code changes as well. Let's say that the hacker who also runs a node of blockchain network wants to alter the blockchain and steal cryptocurrency from everyone else. If there were to alter their single copy, it would no longer align with everyone else's copy. When everyone else's cross-reference their copies against each other, they would see this one stand out and hacker's version of the chain would be easily cast away as illegitimate. So succeeding with such a hack would require that the hacker simultaneously control and alter 51% or more of the copies of the blockchain so that their new copy becomes the majority copy and thus the agreed upon chain, which is typically impossible. Such an attack would also require an immense amount of money and resources, as they would need to redo all the blocks because they would now have different timestamps and hash codes. Due to the size of many cryptocurrency networks and how fast they are growing, the cost to pull off such a feat probably would be insuperable. This would not be extremely expensive, but also likely fruitless. Doing such a thing would not go unnoticed, as the network members would see such a drastic alterations to the blockchains. The network members would then hard fork off to a new version of the chain that would not be affected. This would cause the attacked version of the token plummet in value and making the attack ultimately pointless, as the bad actor has control of the worthless asset. Now, the same would occur if the bad actor were to attack a new value of Bitcoin. It is built this way so that taking part in the network is far more economical incentivized than attacking. Wallet. A wallet, as it implies in our general world, is just a simple is just the same in the crypto world. Like a cryptocurrency wallet is an app or a platform that stores your crypto assets. Cryptocurrency wallet is an app that allows cryptocurrency users to store and retrieve their digital assets. As with conventional currency, you don't need a wallet to spend your cash, but it certainly helps you to keep it. So, all in one place, when a user acquires cryptocurrency such as bitcoins, she can store it as an cryptocurrency wallet and from there use it to make transactions. Like cryptocurrency wallets are apps just like you might run on your smartphone or computer. If you prefer the tactile experience of holding a wallet, you can also buy a physical device that runs on a wallet app. So the first cryptocurrency wallet was introduced by Satoshi Nakamoto when he first released the Bitcoin protocol in 2009. Bitcoin is the most popular and widely used cryptocurrency, but others building upon its blockchain technology have emerged, and any of them can be stored on a cryptocurrency wallets. Wallets can hold multiple cryptocurrencies. So when you want to acquire cryptocurrencies, whether by purchasing it in currency exchange or receiving it as a gift or revenue, you direct the sender to a unique cryptographic address and issued by the wallet, and you might picture your cryptocurrency stored on the wallet the same way files are stored in a USB drive. But the information stored on a wallet only points to your cache's location on the blockchain. The public ledger that record and authenticates all the transactions for a cryptocurrency. Spending with the wallet is simple as scanning a retailer's QR code or directing a specific amount of crypto coins to a retailer's public address. So wallets store your private keys, keeping your crypto safe and accessible. They allow you to send and receive and spend cryptocurrencies like Bitcoins and Ethereum. Like crypto wallets keep your private keys, the passwords that they give you to access to your cryptocurrency safe and accessible, allowing you to send and receive cryptocurrencies like Bitcoin and Ethereum. They come in many forms, from hardware wallets like Ledger, which looks like a USB stick, to a mobile apps like Coinbase wallet, which makes using crypto as an easy shopping with credit card online. Why are cryptocurrency wallets important? We will discuss this topic, like why are cryptocurrency wallets important. Like a normal wallet, which can hold actual cash, crypto wallets technically don't store your crypto. Your holding live on the blockchain, but you can only access using a private key. Your keys prove your ownership of your digital money and allows you to make transaction. If you lose any of your private key, you're lose access to your money. That's why it's important to keep your hardware wallet safe or use a trusted wallet provider. Exchange. The word exchange, what does it mean? Cryptocurrency exchange are platforms that facilitate and accommodate the trading of cryptocurrency for other assets, including digital and fiat currencies. In effect, cryptocurrency exchanges acts as an intermediary between a buyer and a seller and make money through commissions and transaction fees. On common cryptocurrency exchanges, $100 can be exchanged for Bitcoin of equivalent value, and vice versa. Similarly, Bitcoin worth $100 can be exchanged for Ethereum or any other cryptocurrency of equivalent value. The same concept can be applied to different assets based on the what is offered by the exchange. We have two types of cryptocurrencies: centralized and decentralized cryptocurrencies exchanges. Centralized cryptocurrency exchanges acts as a third party between a buyer and a seller since they are operated and controlled by a company. Centralized exchanges offer more reliability. Approximately 99% of all crypto transactions go through centralized exchanges. Example of centralized cryptocurrencies exchanges include Coinbase, GDAX, Kraken, and Gemini. Decentralized cryptocurrency exchange DEX is decentralized cryptocurrency exchange allows user to execute peer-to-peer transactions without the need for a third party or an intermediary. And due to some of the issues associated with centralized exchanges, decentralized exchanges are preferred by some users. So, however, decentralized exchanges do not facilitate the trading or fiat currencies for cryptocurrencies. Example of decentralized cryptocurrencies exchange include Airswap, IO, BarterDex, and Blockchain. Now, the advantages of centralized cryptocurrency exchanges are it's user friendly. Centralized exchange offer beginner investors a familiar friendly way of trading and investing in the cryptocurrencies as opposed to using crypto wallets and peer-to-peer transactions which can be complex, and user of centralized exchange can log into their accounts, view their account balances, and make transactions through applications and websites. Then the second of the advantages that it is reliable. Centralized exchange offers an extra layer of security and reliability when it comes to transactions and trading. By facilitating the transactions through a developed centralized platform, centralized exchanges offer a high level of comfort. Now, the disadvantages of centralized cryptocurrency exchange are that it has a hacking risk. Centralized exchanges are operated by companies that are responsible for holding of their customers. Large exchanges usually hold billions of dollars worth of bitcoins, making them a target for hackers and theft. An example of such an incident is Mt. Gox, which was once the largest cryptocurrency exchange company before it reported the theft of eight like 8,50,000 bitcoins, leading to its suspension. The second disadvantages of the centralized cryptocurrency exchange is that unlike peer-to-peer transaction, centralized exchange offer charge high transaction fees for their service and convenience, which can be especially high when trading in large amount. Now the we'll come on advantages of decentralized cryptocurrency exchange. It is mitigating hacking risk. Users of decentralized exchanges do not need to transfer their assets to the third party. Therefore, there is no risk of company or organization being hacked, and users are assured that of greater safety from hacking and theft. Second advantage is that preventing market manipulation due to the nature of allowing from peer-to-peer exchange of cryptocurrency. Decentralized exchanges prevent market manipulation, protecting users from fake trade and wash trading. Now, anonymity. Decentralized exchange do not require customer to fill know your customer KYC forms, offering privacy and anonymity to the users. Other advantages of decentralized cryptocurrency exchange are complexity, lack of fiat payments, and liquidity stress. So the first one, complexity, is that users of decentralized exchanges must remember the keys and password of their crypto wallets or their assets are lost forever and cannot be recovered. They require the user to learn and get familiar with the platform and the process, unlike centralized exchanges which offer a more convenient and user-friendly process. Now, the lack of fiat payments, decentralized exchanges do not allow for the trading of fiat currency for digital ones, making them less convenient for the user that do not already hold cryptocurrencies. Now, the liquidity struggle is that some 99% of the crypto transactions are facilitated by centralized exchange, which suggests that they are accountable for the majority of trading volume. Due to the lack of volume, decentralized exchange often lack liquidity. So, and it can be difficult to find buyers and sellers when trading volumes are low. Now, the another word is airdrop. An airdrop in the cryptocurrency world is marketing stunt that involves sending coins or tokens to wallet traders to promote awareness of a new virtual currency. Small amount of the new virtual currency are sent to the wallets of active members of blockchain community for free. or in return of a small service, such as retweeting a post sent by the company issuing the currency. In a short, understable form, crypto airdrop is a marketing method employed by startup in the cryptocurrency space. It involves delivering bitcoins or tokens to the wallets of current cryptocurrency traders, either for free or in exchange for a small promotional service. The airdrop is meant to spread awareness and increase ownership of the currency startup. The airdrop is a promotional activity typically performed by a blockchain-based startup to help bootstrap a virtual cryptocurrency project. It aims to spread awareness about cryptocurrency project and to get more and more people trading in it when it lists on an exchange as an initial coin offering. ICO. Airdrops are generally promoted of the company's website as well as on the cryptocurrency forum. And the coins or tokens are sent only to current holders of crypto wallets. Usually, those are bitcoins or Ethereum. Imagine if a new cryptocurrency exchange like Binance or WazirX is going to open up soon to gain maximum eyeballs within the cryptocurrency world. The platform launches its virtual currency like WazirX and WazirX token or Binance or has Binance coin. The platform then announces its various online channels that it will give away X amount of that currency for free to some early users. In return, it might ask the users to register with the platform, share it updates, and share it updates on the social media accounts or platform other such tasks to enroll. Now, those who complete this task then become the participants of the airdrop. Once the date of the airdrop arrives, the platform transfers the promised amount of its virtual currency to some lucky winners. Note that each platform may have different requirement for participation and that even completing all the listed tasks will not guarantee you an airdrop in most cases. This is simply because the number of participants is too huge with people actively participating in such deals. Now, to qualify for a gift, a recipient may need to hold a minimum quantity of the cryptocurrency in their coins in their wallet. But most common way is that they may need to perform a certain task, such as posting about the currency on social media forum, connecting with a particular member of the blockchain project, or writing a blog post. A legitimate crypto airdrop never seeks capital investment in the currency. Its aim is purely promotional. On the other hand, some crypto scams involve sending micro amounts of Bitcoin or other cryptocurrencies to unsuspecting recipients in what is known as a dusting scam. User should always be vigilant about unsolicited deposits in their crypto wallets. Now, another term is token. So the term crypto token refers to a special virtual currency token, or how cryptocurrencies are dominated. These tokens represent fungible and tradable assets or utilities that resides on their blockchains. Crypto tokens are often used to fundraise for crowd sales, but they can also serve as subtitles for other things. These tokens are usually created, distributed, sold, and circulated through the standard initial coin offering (ICU) process, which involves a crowdfunding exercise to fund project development. As noted above, crypto tokens are cryptocurrency tokens. Cryptocurrency tokens or virtual currencies are denominated into these tokens which resides on the blockchain. And blockchain are a special database that store information in blocks that are chained or linked together. This means that crypto tokens, which are also called crypto assets, represent a certain unit of value. Here it how all it works. Crypto refers to the various encryption algorithms and cryptographic techniques that safeguard these entries, such as elliptical curve encryption, public private keys, and hashing function. Cryptocurrencies, on the other hand, are same that allow for secure payment online, which are denominated in virtual tokens. These tokens are represented by ledger entries internal to the system. These crypto assets often serve as an transaction units on the blockchains that are created using the standard templates like that of the Ethereum network, which allow a user to create a token such as blockchain work on the concept of smart contracts and decentralized applications, wherein the programmable self-executing code is used to manage the various transactions that occur on the blockchain. For example, you can have a crypto token that represents a certain number of customer loyalty points on a blockchain. It is used to manage such details for a retailer chain. There can be another crypto token that gives entitlement to the token holder to view 10 hours of streaming content of video sharing blockchain, Another crypto token may even represent other cryptocurrencies, such as crypto token being equal to 15 bitcoins or on a particular blockchain. Such crypto tokens are tradable and transferable among the various participations of the blockchain. Coins are a form of currency that can be used to make purchases, but you can use crypto token for many other reasons as well as including an investment and to store a value. Special considerations: tokens are created through an initial coin offering, which represents the cryptocurrency version of an initial public offering IPO. Tokens are created by cryptocurrency companies that want to raise money. Investors who are interested in the company can purchase these tokens. Investors can use crypto tokens for any number of reasons that they can hold on to them to represent a stake in the cryptocurrency company, or for an economic reason to trade or to make a purchase of goods and services. As a practical example, decentralized storage provide Bluzil allows investors to stake their native tokens that help secure its network and earn transaction fees and rewards. A crypto token is a virtual currency token on a denomination of a cryptocurrency. It refers to the tradable assets or a utility that resides on its blockchain and allows the holders to use it for investment or economic purpose. Now, what is the purpose of token? Crypto tokens can be represented investor stakes in the company, or they can serve an economic purpose. Just like a legal tender, this means that token holders can use them to make purchase, or they can trade token just like other securities to make profit. How to make money with crypto? Due to high volatility of the market, just a single trend can make you a billionaire and can also make you poor within a very short time. That's why I will be discussing the crucial things and the skills you will need to learn before venturing into cryptocurrencies or before thinking of making money with it. I'm not saying you should be an expert in this area of skill before starting, but make sure you know the most valuable things that will maximize your losses, because I will be sincere with you. Trading crypto is a game of risk where you have two sides parties ready to feast on each other's loss. As you are working hard to win, it means some of the people will have to lose for you to have your profit. And the people we are talking about may be experts who barely lose. Airdrop hunting. We have explained what airdrop is in chapter 2, but now I will be explaining how we can make money with airdrop. Since it's established that airdrops are mostly times gives freely for promotion purpose by developers and companies who are trying to launch their crypto tokens. With some little research done, you can guess from the start of the token will be one day valuable, or it's just a waste of time. Studying some functions of the airdrop can reveal a lot about its qualities, because you need to be careful when it comes to airdrop hunting. There are a lot of scams out there that can wipe away your entire wallet when you give them access. Now the questions are how I can know a good and legit airdrop. How to recognize legit airdrop? To recognize a legit and profitable airdrop, all you have to do is research. But while researching, keep the following points in mind. The community. A big part of the cryptocurrency success is the following. So look out for the cryptocurrencies, the strong communities and loyal followers, because the show people have genuine interest and beliefs in cryptocurrencies. Run through some subreddits, YouTube channels, and some of the feedback for their communities, and see what they are saying about your potential investment. If you are confused about the coins, going to the forums and checking out the community on Reddit is a great way to start understanding the hype behind an altcoin and where you should invest. So you will also find in Reddit that some of the most difficult and technical concepts are often broke down and explained simply in these forums. So larger cryptocurrencies communities usually have a very active Reddit communities, but even the smaller communities are very helpful and usually happy to answer any question. So if you need some help understanding how to proceed works and the technology, etc., then there is a community is a great place to start. Second is fundamental analysis. A fundamental analysis simply means that a foundation of an investment, their team, their ambition, their strength, etc. If you are new to cryptocurrency, don't sweat the technical stuff. In the long run, fundamental analysis is going to help you just as much as technical analysis. So understand how the fundamental analysis will help you make the better investment decisions. And in a market where most people are chasing after low quality altcoins, fundamental analysis allows you to separate the wheat from the chaff. Now the third is important, which is the team. One of the top things you can research is the cryptocurrency team. Researching and vetting the team behind the cryptocurrency is one of the most important factors you can look into. Here are a few things to analyze. Who is behind the cryptocurrency? Do you trust in their expertise? Are they ambitious? Do they have proven track records of a success? These are all the important questions when you are deciding which cryptocurrency to invest in, because a team has a power to steer them to success or failure. Now, fourth, technology. A big part of cryptocurrency success is underlying technology. You have to understand how it's going to perform against its competitors and what makes the technology stand out from the crowd. Look out for the big innovators, the cryptocurrency that will completely disrupt their industries. For example, let's take Ethereum. Now, Ethereum is one of the best cryptocurrencies technology wise because of smart contracts. This is the form of technology that facilitates the exchange of anything of value. It is a little technical, but you can read more about it here. And like Ethereum technology is designed to make it easy for developers to integrate the blockchain with their applications. Ethereum virtual machine technology EVM. This tech makes it easier for developer to create applications on a bigger scale. Because Ethereum is such an innovative technology, it's quickly become one of the biggest cryptocurrencies in the world. So the next one is white paper. Every time a new cryptocurrency is released, they usually bring out a white paper too. This will outline the purpose of the coin, its technology, how it's work, and its overall vision. A white paper is one of the best places to evaluate the fundamentals of a coin. And you should never invest anything into it until you have read the white paper. So you might have to wade through a little technical jargon in the white paper, but don't let that put off. It's 100% worth reading because it's such a nice, rich source of insight. Plus, the more white papers you read, the better you will become at identifying the long-term winners. A white paper can also tell you about the cryptocurrency's professionalism and credibility. Here are some red flags to watch out for. The one is the cryptocurrency promising something unrealistic? Is the white paper ambitious in terms of its overall objectives? Are there spelling mistakes? If there are more than few, this is a big red flag. A company that can't invest the time into getting their white paper right probably isn't serious about the future. The sixth is the vision. A vision of a cryptocurrency is really important. You want to make sure that the coins will be around for at least next 5 to 10 years, and if they are not thinking of long term, then you should be seriously worried. A big vision is equal to a big ambition. Now, and without a clear vision and ambition, the coin is going to struggle to become a real competitor and a disruptor in the industry. So, also, whether it's a white paper and social media or the website, try to identify their intent for the future and the coin. And also look at the community, see what type of culture is being created. You should only invest in the cryptocurrency with a strong vision that you can go distance and pay off in a long run. While short term gains can be exciting and you might be thinking about swing trading, you should still think about whether the cryptocurrency is going to be in the next 5, 10, 20 years, etc. So, this is all I want to say. And then we have the leadership. The success of a coin is navigated by the leadership team. They are the one who make all the big decisions. The leaders are the one they carry out the vision. So research their team and look at what they have achieved so far. You want to be assured that if they are the champions of the vision, then they can lead that coins to success. See if they are personally invested in the project. Look at other cryptocurrencies related projects they have worked on, or if they have any relevant experience. Do they have reputations as a CEO? Research what their leadership teams has said about the coins and what they are trying to achieve. Now, pricing history. Ever heard the saying the best predictor of future behavior is past behavior? Of course, this isn't always the case, especially with cryptocurrency. However, pricing fluctuations give you price history. Ever heard the saying the best predictor of the future behavior is the past behavior? Of course, this isn't always the case, especially with cryptocurrencies. However, pricing fluctuations give you a strong history of the coin, and if strong history of the coin, and if it will be a solid investment over the future or not. Are they volatile in value? When the market takes a big dip, which it regularly does, was the coin resilient? Are they priced at a high time high? If they will hit an high time all time high, I would recommend waiting it out until the cryptocurrency takes a dip. Understanding the pricing history of a cryptocurrency could be a new concept to you. Most people have no idea what they are looking at. Now, looking at the current pricing offers is current price is one thing, but some people want to try forecast price movements. Attempt to go forecast price movements of anything that is traded at an exchange is a game of chance. No one is going to be right all the time. So, if you are a beginner, I wouldn't worry about predicting the future price. Just stick to the fundamentals. Credibility and reputation. Is cryptocurrency respected online? Do they have a strong reputation? At the end of the day, if they have a bad reputation, then you probably shouldn't invest your money into them. You need to have a strong credibility and trust to be success in this field. So run some Google searches, look through cryptocurrencies and see what people are saying about the coin. The other thing here is that if you want to invest in a crypto that people feel positive about, you have to avoid scams. So if you find a coin that looks like a MLM scheme or a pyramid, get the hell out of there. The roadmap. When you're deciding which cryptocurrency to invest in, you should look up for a coin with a solid roadmap and a strong plans for development. How to find a legit and a profitable airdrop. With large number of crypto projects out there, it should be of no surprise that many of the coins and tokens received during cryptocurrency airdrop end up holding very little value in the end. Still, for all the unsuccessful airdrops out there, from time to time, there are a few gems that may be uncovered. And for that, it is worthwhile to keep track of and monitor potential airdrops from existing and the upcoming projects. Finding a legit and profitable airdrop may seem stressful sometimes, but that will be if you don't know the right place to check. The following steps will lead you right to legit and profitable airdrops. Interested in individuals can take normal route and follow hashtags such as airdrop on Twitter. Additional sites like airdrop, live on airdrop, and also maintaining running lists of upcoming events and past airdrops which have taken place. Regularly monitoring social media platforms, and these sites will not only help keep users up to the date on the latest crypto projects, but will also allow individuals to be among the first to know about exciting new blockchain use cases and ambitions. After signing up for an airdrop, once registers for an airdrop with an exciting new project, usually generally needs to wait for an airdrop to take place. In the meantime, users should stay close to the project, following their social media channels and following any announcement that may be released about the airdrop. Stay vigilant. The cryptocurrency space is still in the nascent stage of growth, and with numbers of ongoing projects out there, many organizations and parties are fighting to be the winners in the web world 3.0. Through all of this excitement, there are many bad actors out there who will be taking advantage of the individuals who are trying to legitimately invest and learn in this complicated industry. The fifth point is invest individuals who wish to participate in the airdrop should take all the necessary precautions to safeguard their personal and financial information. Serious red flags for airdrops include the request for wallet private keys, funds in advance, fiats, credits, or crypto, or personal information such as national ID number. Examples are social security numbers, passport numbers, etc. Personal address, bank accounts, etc. Individuals should also be wary about utilizing the same wallet for airdrops as they do for all of their other blockchain transactions. As most blockchains are recorded on a public ledger, full visibility into the prior transactions and account balances of a wallet are visible. Individuals may be targeted more aggressively if the account balance of a particular wallet are known. So it is incredibly um, So I want to say that it is an incredibly exciting time to be in crypto, and there is a lot of growth and change up ahead in the blockchain world. However, there are still many parts of the industry they are that are vulnerable to the new entrants in the crypto space, and participants should be on high alert for the exposure of their personal and finance information. Now, investing and holding. There is another way of making money in crypto. Investing in crypto simply means buying a crypto coin with the aim of purpose of keeping it for a very long time. People who chose this line of monetization are known as holders or long-term traders because they never had the intention of selling out their coins in a short time. This is one of the most common ways that you can make money in crypto. This doesn't require much of any time and any other means of monetization crypto, because once you buy, all you have to do is watch for the right time to sell, then make your profit. However, you must know these types of coin you are holding, because there are many coins out there that are just useless, and no matter how long you hold them, they may not yield any profit. I can assure you that you will surely make a mistake getting a coin like this too, but you will learn from it. Now the question here is how I know the right coin to hold and the right time to sell them off. How to know the right coin to invest in. So, knowing the right coin to invest in is a very important aspect. We must not ignore there are thousands of coins out there, and there are still more coming out almost every day. Because if you don't know, crypto will surely be displacing our note currency one day. And if you are not aren't in the trend by then, catching up may seem a little bit difficult. So among those coins we have right now, there are so many of them that don't worth investing in them. Even though you plan to hold for a very long time, some of them would never pay off in the next 5 years, and this is loss on your side. The following are qualities you should look out for a coin before investing them. Security. Your cryptocurrency needs to be chosen with financial security in mind. The ideal cryptocurrency will have security built into its native design. This means apart from two-factor authorization and complex passwords, it will include safety features built into it to prevent itself from getting hacked. Now, while you don't need to do a full deep dive into the technical aspects of the cryptocurrency, you do need to do a basic research to ensure it has some amount of inbuilt security features to avoid itself from being hacked or in a sophisticated means. Stability. Chasing stability in the world of cryptocurrencies can sometimes sound like an oxymoron. After all, cryptocurrency will only be truly stable if people, organizations, and countries decide to use it, and that seems some way off into the future. That doesn't mean cryptocurrency like Ether and Bitcoin are unstable. The ideal cryptocurrency funds is its stability over time. As the number of transactions performed in the currency grows, which is exactly what has happened with both the cryptos. Choosing cryptocurrencies that follow this model is a good way to invest in them. Scalability. The scalability of the cryptocurrency refers to the number of transactions that can be processed or confirmed per second. Today, we prefer paying online versus depositing a check because of the time differences in transactions times. Blockchains use different methods to settle transactions, although the best ones are also the fastest. Look at the forums that address this issue and pick cryptocurrencies whose transaction get processed in this shortest time frame. Supply. So the main problem of regular or fiat currencies is that one can print as much as it is required. Some people have already sounded the alarm about an upcoming debt crisis because of an easy money that was printed to support economic during the COVID-19 lockdowns. Cryptocurrencies, however, can escape this problem of supply. Most have fixed amount of coins that will ever exist. Bitcoin, for example, can have maximum of 21 million coins in existence and no more. Other mostly newer coins also burn cryptocurrency tokens by sending them into inaccessible wallets. This limits the total number of cryptocurrencies available and make them more valuable over time. WazirX recently held its sixth coin burn event where it burned 5,933,000 WazirX, equivalent to Indian 74.8 crore, taking its total tally of burned coins to 21 million 7 lakh and 86,665 worth of over 47 million US dollar. Having a cryptocurrency that regularly undertakes such a measure to keep a fixed number of coins in a circulation is a good indicator of a strong cryptocurrency. Decentralization. The whole idea of cryptocurrency is to give people power to people instead of holding organizations. One of the defining features of Bitcoin is that no one knows who created it, despite attempts to uncover the identity of Satoshi Nakamoto. Some cryptocurrencies, on the other hand, try to take away from this decentralized nature of the blockchain to try to manipulate their currency. If you ever come to know the identity of any people or organization behind any particular cryptocurrency, sell it off right away. Even though it's not directly related, always remember how the Squid Game scam played out. Demand. This one is pretty simple. Pick a cryptocurrency that has a demand. By demand, we mean that the cryptocurrency is in news and has potential to grow over by time through the word of mouth and other means such as media coverage. Availability and exchange such as Wazirex. The idea is that earlier you invest in cryptocurrency, the more valuable it gets. Others begin discovering it. Use case. One important aspects of cryptocurrency is how to use them the way you might use cryptocurrency to buy and trade for goods and services. This is one aspect that not many people give a thought to when buying cryptos. But if you think about it, having the adaptability to pick up something worthwhile with your crypto is a pretty interesting prospect. How to know when to sell. One of the qualities of a good trader is knowing when to buy at the right time to sell. The fact that you are an investor doesn't mean you won't sell your coin. Moreover, some coins that you think are good ones may tend to turn out bad along that line, which may change your decisions of keeping them for a long time. With this, selling at the wrong time can minimize your profit. It doesn't cut through your capital. However, today traders could not use traditional finances concepts to predict accurate cryptocurrency price movements. Many have tried, but our attempt has been stymied by the unprecedented volatility of the market. Even the most accurate price predictions based on the chart analysis have shown that no methods are sufficiently consistent to qualify as a technical strategy. Truth to be told, you never know what the market will do. That is why it is so hard to predict when to buy, sell, or hold your cryptocurrency at any point. So the following are the signs you should watch out for that shows you it's the time to sell. If you ever decide to hold any cryptocurrency, keep a watch out for any news or events that impact the price of your invested cryptocurrency. Whenever there is any news that may sink the value of your coin, sell some of the coins to avoid losses. Never hold everything. Part of learning when to hold or sell is realizing that it's not always wise to hold all your bitcoins. Volatility makes the market likely to have extreme spikes and crashes. If you notice a significant price drop and have banked all your investment money, you may need to read about the new investment strategies. However, there is still a way to get things right and let cryptocurrency climbs up a bit. Holding a portion or selling another portion allows you to hedge your investment and reduce the risk of losing everything. Never let the choice of depend on fear or despair. Cryptocurrency is volatile, enormously so. It's enough to make most people panic sell when they are not supposed to. This could lead to losses as the current could jump back. Instead of selling zero, many investors sell just enough cryptocurrencies to make the end meet for a bit while keeping the rest in hold. This allows you to remain financially stable while wanting to see now things are how things are going. Don't let FOMO trick you into holding your coins. Fear of missing out. That's a pain. We have all had the currencies we have sold just to see the prices spike the next day. It's a part of the game, and that's why that's why many traders make a mistake about hold. So when they really should have crashed out on their profits and waited for the next dip to be reinvested. And don't get greedy. You could lose all your profit much faster than you accepted. Altcoins with a little or no purpose sell out quickly. The coin doesn't seem to be competitive anymore. It's no matter of whether to sell or to hold, just sell them while you get a chance. Likewise, they sell underdeveloped and overpriced coin. The real number of people who get cryptocurrencies isn't that high at all. Cryptocurrency run on a hype, and the truth is most coins are overhyped and overvalued. overvalued coin. Unless they are at the top of the coins, they are not ones to invest in. They are the coins that often end up in a major crashes. As a result, seeing much more hype without backing or widespread use is often a sign that you should sell. If the community of coins shrinks, sell some of them. Most cryptocurrencies do not have a product or company that supports them. They are supported by disparate users and online communities. If you no longer hear about a coin or implementation dries up, it's probably a bad sign. Cryptocurrency needs people who use them to survive, and they need to be highly value added. If no one uses them, they are not worth much, and they might just be dropped from the exchange platforms. If your coins drop a major exchange, sell if it is possible. A lot of altcoin increase their value as they appear on a major exchange like Coinbase. Once the top exchange of the coin stops carrying your cryptocurrencies, otherwise will often follow suit. As a result, you will end up with a dead cryptocurrency. If this happens, there is no guarantee that your coin will be sold. Selling while there is a chance is a good way to avoid losing everything you have stored in your cryptocurrency. If your government is looking to clamp down on cryptocurrencies, consider selling. Mining. Mining is another way you can make money with crypto. Many don't pay attention to this aspect because it's survival of the fittest. What is mining? To put it into very simple terms, crypto mining is a process in which machine performs certain tasks to obtain a little bit of cryptocurrency. Imagine that you have a machine that mines crypto coins. We'll talk about the specific types of machine later on the tutorial, but for example 6, let's just say that it's your own personal computer. You're trying to figure out how to mine cryptocurrencies. Your PC would perform specific tasks that are required to be able to obtain even the slightest amount of cryptocurrency. These are called proof of work, and they are designed to create a fair playing field for all the different miners out there. The tasks themselves are math equations. The more miners want to mine one specific mining pool, the tougher the equation becomes. This brings balance to the pool, but it also motivates bigger and stronger machinery usage. Many more subtle factors come into play while the mining process is happening, but the general idea is that if your device contributes to the mining, you will get a share of the spoils. That is very short and simple way of defining what cryptocurrency mining is. Now let's move on to what you came here to see: how to mine cryptocurrency. There are few ways you could go about cryptocurrency mining. I will cover the main ones here. And to start from the easiest one, cloud mining. Cloud mining is if you are looking for crypto mining ways. If you're looking for crypto mining ways, cloud mining is probably the most popular way of mining cryptocurrencies without having to lift a finger. Cloud mining is a process where you pay someone, most often it's a big corporation, a specific amount of money and rent out their mining machines called a rig and the process of mining itself. This rent lasts for an agreed upon period. This rent lasts like through which all the earnings that rig makes are transferred to your cryptocurrency wallets. The people that offer cloud mining services usually have huge mining facilities with multiple farms at their disposals and known perfectly well how to mine cryptocurrency. Cloud mining has become so popular mainly because it offers the possibility to participate in the world of cryptocurrency. For people who might not have money to buy the rigs or who perhaps simply aren't interested in owning a rig, there are two options for cloud mining: free and paid. Naturally, a lot of people that are looking for ways to mine cryptocurrency would gravitate towards the free options, but it does not have its drawbacks. But it does have its drawbacks. Sorry. Uh, Paid cloud mining usually work like this. You will find a cloud mining host online. You check out the plans that the host offers, and then there are usually 4 or 5 of these plans, ranging from the cheapest to the most expensive ones. Some hosts even offer you the ability to create and customize your cloud mining plan. Once you know what you want, you simply perform the transactions, register your cryptocurrency wallet, and that is how you make the first step on how to mine cryptocurrency. Different plans cost different amounts of money and last for a variety of periods. The standard plan can go anywhere about $500 to $5,000 and last from 2 years to a lifetime. It is usually expected that you will break even at around a half a year, 1 year mark, and then profit from that point onwards. No one can know for sure. Though, because the prices of the cryptocurrencies are very volatile, their prices tend to swap by quite a bit. CPU mining. Let's understand this. CPU mining utilizes processors to mine cryptocurrencies. It is used by a viable option back in the day, but currently fewer and fewer people choose this method to mine cryptocurrencies daily. There are a couple of reasons why that is. First of all, CPU mining is extremely slow. You could go on for months without noticing a smallest amount of revenue. It's also usually not worth it. You make a very little amount of money, but you probably spend 10 times that amount on electricity and cooling. The probability mitigates itself a bit if you can find a place that has nice cooling and cheap electric bills, but that's rarely the case. So why people still even use CPU mining then? Well, basically because anyone with a desktop computer could do it. All you need to be able to mine using the CPU method is just computer and a couple of programs. It's possible to do with a laptop, but it's very strongly not advised. Your laptop will probably fry and overheat in a matter of couple hours. The fact that it's so easy to start a cryptocurrency mining attracts new CPU miners every day. Some people that are looking on how to mine cryptocurrency don't care about the details. They just want to start the process as soon as possible and in any way possible. As GPU mining. GPU mining is probably the most popular and well-known method of mining cryptocurrency. If Google cryptocurrency mining, GPU rigs are going to be some of the first thing that you will see. Cloud miners, for example, uses GPU rigs for their service, and also these guys are professionals that sometimes have hundreds, not thousands of rigs, if not thousands. So they probably know what they are doing, right? So GPU mining is very popular because it's both efficient and relatively cheap. Don't get me wrong, the construction of the rig itself tends to be costly, but when it comes to high speed and general workforce, the GPU mining is great. GPU rigs utilizes graphics cards to mine cryptocurrency. One standard rig is made out of a processor, motherboard, cooling rig frame, and of course a few 2 to 8 graphic cards. A typical price for well-performing and nicely built GPU mining rig aims to be around $3,000 price range. It is a hefty investment, but will pay off much faster than, let's say, CPU miner. People looking for ways to mine cryptocurrency should check them out. ASIC mining. ASIC stand for Application Specific Integrated Circuit. These are some special devices that are designed explicitly to perform a single task, which in the case is crypto mining. ASICs are very well known and treasured because they produce insane amounts of cryptocurrency when compared to their competitors GPU and CPU. Well, mostly because they are a big subject of controversies. You see, when then ASICs companies are announced its new version of the machines, the announcement caused an uproar in the cryptocurrency community. Many people have called for an outright ban on these machines. Why? Because ASICs are so powerful they rob other miners who are using GPU or CPU rigs of the possibility to keep both in hash and speeds and in earning. Also, ASICs have twisted the economy of certain specific cryptocurrencies. Imagine if majority of earnings would go to one miners with an ASIC farm, what kind of chaos would ensue? Now that you have understand of how mine of cryptocurrencies and all about the different ways to do it, which one is the best? This is the question. The method that suits you the most depends solemnly on few key details. Are you willing to spend some initial money? If so, how much? Do you want to own a rig? Do you even want to do it with a rig? These are many more simple questions will determine your best method for mining cryptocurrencies. Generally speaking, GPU and cloud mining seems to be two big options that people love. CPU mining is slow and tedious, while ASIC mining could get unpredictable, especially as of late. If you want to build your rig, then GPU is the way to go. If you don't want to spend a dime and just get going ASAP, you could give CPU mining a shot. However, if you are willing to risk and if you are not afraid of controversies, ASICs are a great bet. And if you don't want anything to do with neither rigs or not type of machinery, cloud mining is best bet on how to mine cryptocurrency. Staking. Staking cryptocurrency is a process that involves committing your crypto assets to support a blockchain network and confirm transactions. This is also means to make money in crypto that hasn't been noticed by so many people. It's available with cryptocurrencies that use proof of stake model of process payments. This is a more energy efficient alternative to the original proof of work model. And which requires mining devices that use computing power to solve mathematical equations. Staking can be a great way to use crypto to generate passive income, especially because some cryptocurrencies offer high interest rates for staking. But before you get started, it's important to fully understand how crypto staking works, how staking works, how staking in crypto works. So let us understand it. uh, the thing is that with cryptocurrencies that use the proof of stake model, staking is how new transactions are added to the blockchain. First, participants pledge their coins to the cryptocurrency protocol. From those participants, the protocol choose a validators to confirm block of the transactions. There are more coin you pledge, the more you are likely to be chosen as a validator. Every time a block is added to the blockchain, the new cryptocurrency coins are minted and distributed as a staking reward to that block's validator. In most cases, the rewards are the same type of cryptocurrency that participants are staking. However, some blockchain use a different type of cryptocurrency for rewards. If you want to stake crypto, you need to own a cryptocurrency that uses the proof of stake model. Then you can choose the amount you want to stake. You can do this through many popular cryptocurrency exchanges. Your coins are still in your possessions. When you stake them, you're essentially putting them to work, and you're free to unstake them later if you want to trade. The unstaking process may not be immediate, and with some cryptocurrencies, you require to stake coins for a minimum amount of time. Staking isn't an option with all types of cryptocurrencies. It's only available with cryptocurrencies that use the proof of stake model. Many cryptos use the proof of work model to add blocks to their blockchains. The problem with proof of work is that it requires considerable and computing power that lets significant energy usage from the cryptocurrency that use proof of work. Bitcoin is particularly has been criticized due to environmental concerns. Proof of stake, on the other hand, doesn't require nearly as much as energy. This also make it more scalable option that can handle greater number of transactions. What is proof of stake? Proof of stake in crypto is a consensus mechanism, a way of for a blockchain to validate transactions. The nodes in a blockchain must be in an agreement on the present state of blockchain and which transactions are valid. There are different consensus mechanisms that cryptocurrencies use. Proof of stake is one of the most popular for its efficiency, and because participants can earn rewards of the crypto they stake, staking rewards are an incentive that blockchain provide to the participants. Each blockchain has set amount of crypto reward for validating a blockchain transactions. When you stake crypto and you are chosen to validate transactions, you receive those crypto rewards. Benefits of staking crypto. Here are the benefits of staking crypto. It's an easy way to earn interest in your cryptocurrency holdings. You don't need any equipment for crypto staking like you would for crypto mining. You are helping to maintain the security and the efficiency of the blockchain. It's environment friendly than crypto mining. The primary benefit of staking is that you can earn more crypto, and interest rates can be very generous. In some cases, you can earn more than 10 to 20% per year. It's potentially a very profitable way to invest your money. And the only thing you need is crypto that uses the proof of stake model. Staking is a way, also a way of supporting the blockchain of a crypto you are invested in. This cryptocurrency rely on holders staking to verify transactions and to keep running smoothly. Now the risks of staking crypto. There are a few risks of staking crypto to understand. Crypto prices are volatile and can drop quickly. So if your staked assets suffer a large price drop, that could overweight any interest you earn on them. Uh, uh, During that period, you are unable to do anything with your staked assets, such as selling them. When you want an unstaken crypto, there are many unstaking periods of 7 days or longer. The bigger risk you face with crypto staking is that price goes down. Keep this in mind if you find cryptocurrencies offer an extremely high stake reward rates. For example, many small crypto projects offer high rates of entice investors, but their price then end up crashing. If you are interested in adding crypto to your portfolio, you would prefer less risk. You may want to opt for crypto currency stocks instead. Although the crypto that you stake is still yours, you need to unstake it before you can trade it again. It's important to find out if there is a minimum lockup period and how long the unstaking process takes you, so don't get any unwelcome surprise. When you should or should not stake crypto. So the thing is, when you should or you should not stake the crypto. If you have a crypto that you can stake and you aren't planning to trade it shortly, then you should stake it. It doesn't require any work on your part, and you will be earning more crypto. What if you don't have any crypto and can you stake it? Many offers are stake, but you should first evaluate whether each cryptocurrency is a good investment. It only makes sense to buy crypto for staking if you also believe it's a good long-term investing. Consider the returns you can make. It's worth researching these and cryptos with staking. You may be wondering why only some cryptocurrencies have staked. As previously noted, proof of stake isn't the first or the only consist mechanism. Proof of work was the first consist mechanism since it's originated with Bitcoin. Other early cryptocurrencies followed in its footsteps unless Peercoin introduced proof of stake in 2012. There is also debate over which consensus member is more secure option. Although the computational power required by proof of work use substantial energy, it also makes proof of work blockchain difficult to attack. Some cryptocurrencies choose proof of work for this reason. The proof of stake model has been beneficial for cryptocurrencies and investors. Cryptocurrency can use proof of stake to process large number of transactions at minimal cost. Crypto investor also get the opportunity to collect passive income from their holdings. Now that you know more about staking, you can start investigating cryptos to offer it. Lending. Now, what is lending? Investor lend fiats or cryptocurrencies. Lending as its sound means it's a normal physical word. Is the meaning here too in crypto? In other words, lending also means borrowing. This is also a rare means of making money in crypto, but I can say it's one of the best way to make money in the crypto world. What is lending? Investor lends fiats of cryptocurrencies to other borrowers in exchange for interest payments on those assets. The two main parties involved as are the lenders who will receive interest from the borrowers in exchange for the loan, and the borrower who will deposit crypto assets as collateral to secure the investor's investment. Crypto borrowing and lending have become increasingly popular over the last few years. Just like traditional lending, you can loan out your digital assets to receive high interest from whoever is borrowing from you. Some many solutions and platforms let you give out or take a loan with your crypto. However, it does work slightly differently than these traditional loans. If you are a crypto investor, crypto lending can provide you with immediate returns, and you don't even have to sell any coins. Type of lendings: fixed. Think of a fixed lending like bank CD. It's lock in your deposit at a predetermined rate for a set period, typically 7 to 90 days. The reward for not touching your crypto is it pays higher interest. This can make you ton of money in the long run, but the risk is also high because some borrowers don't pay up as promised, and some exchange platforms don't have policies that can help them retrieve the borrowed assets. But not all exchanges. Flexible lending is more like savings account. You can withdraw your crypto at any time, but the return rates are lower. This seems a little bit safe. Advantages of lending: attractive interest rate. The main benefits for lenders is that a high interest rate, you will likely to get more crypto than the amount that you have lent out. Therefore, you will be making a profit without needing to do hardly anything for it. Additionally, the interest rate is much likely higher than that of your savings account. Avoiding crypto volatility. In, gen- in general, you can lead almost whatever crypto you want. However, lending stablecoins may appear like a newer solution for crypto owners by lending stablecoins or digital assets pegged to a local currency. You can grow your assets without the risk that you typically have with crypto. In short, you will be likely to be able to predict how much you will be getting back before even lending out your crypto assets. Steps to take if you want to venture into leading: find the right exchange and choose the coin you want to lead. So, finding the right exchange. Not all cryptocurrency exchanges let you lend out all your crypto. Each exchange is different, and interest rate can vary greatly depending on the type of the loan. So, on the type of the loan or the coin you loan out. Binance, the largest crypto exchange by volume, offers several investment products internationally through Binance for a both fixed and flexible lending. Unfortunately, this is not currently available in the US. Then there are exchanges like KuCoin that provide a marketplace for peer-to-peer P2P lending. Users can either set their fixed lending rates or lend at the current market. Within an exchange, it's important to know your funds are safe and secure. Not all exchanges follow the same compliance guidelines set by US regulators. Key among them, know your customer KYC rules that verify customers identifies and crucial curtail criminal activity. US based customers may risk getting their accounts shut down on exchanges that do not comply with KYC rules. Choose the coin you want to lend. Although there are over 9,000 cryptocurrencies according to CoinMarketCap, most exchanges only allow users to lend a few dozen of them. So the question is, which coin should you lend? That depends on how you desired returns, market condition, personal risk tolerance. There are two main crypto lending strategies to consider. You can earn interest on stable coins or cryptos like bitcoins that you plan to hold. Stable coins like US dollar and Tether USDC and USDT aims to peg their value on one-to-one basis to US dollars. Hence the name, regardless of the market volatility, the price of stable coins remains unchanged, making them lower risk option. But not at all stable coins are backed by the same reserve assets, which raises the question of how how stable they are. Bitcoins and altcoins are highly volatile. As such, the amount you can earn in interest may be unpredictable. Lending them out may appeal to investors who want to hold their coins and still get paid. But it also means any change in the price of the crypto will affect their income. Investors who use fixed lending services should be prepared for sudden changes in the value, as they won't be able to trade coins that are tied up for set periods. Fact Facts to take notes. In crypto lands, returns are not guaranteed. Most crypto exchanges do not have the same protections as traditional FDIC insurance insured bank accounts. FDIC insurance covers consumers against losses of up to 250,000 if the bank fails or funds are stolen. Some exchanges like Gemini vet their borrowers through a stringent risk management process. Other like KuCoin do not. However, KuCoin does claim lenders you can always get full repayment through its insurance fund if borrowers default. With high returns come high risk. Exchange can have failed. Coins have been pumped and dumped. As with any investment, it's not a good idea to risk money you may need in the short term that you cannot afford to lose. Then there are fees which can add up quickly. Most exchanges charge a fee to buy a crypto, a fee to sell crypto, a fee to withdraw crypto, and there are blockchain fees you may have to pay to make transfers from wallet and exchanges. If you are not careful, fees can take a serious bite out of your earnings and put you into a red before you even start lending. With this in mind, it's best to map out a different lending time frame. That way you can calculate whether the interest you might earn will cover any fees. NFTs. NFTs is a new trend that just got popular in the year 2021. Even though the concept has been into existence for a couple of years now, NFTs are non-fungible tokens. These are the pieces of cryptographic tokens that exist as a blockchain. They use for real world items like artwork, music, art, and even real estate. But in virtual capacity, unlike cryptocurrencies, NFT cannot be traded or exchanged because they are non identical to one another. Think of a baseball card or a rare coin collection. NFTs create scarcity among assets that are otherwise finitely available. They are typically used to buy and sell digital items like tweets, artworks, gaming skins, and virtual real estate. 2021 was the year of growth for NFTs, with the sales hitting 2.5 billion in the first half. 2021 was a year of growth for NFTs, with the sales hitting 2.5 billion in the first half of the year. There are two ways you can make money with NFTs. The first is to sell your original content as an NFT. An NFT can be used to represent virtually any type of real or tangible item, including artwork, virtual items with video games, such as skins, virtual currency, weapons, and avatars, music, collectibles, tokenized real world assets, from real estates and cars to race horses and design sneakers, virtual land, video footage, and iconic sporting moments. How to make money with NFTs? NFTs are generally sold on marketplaces with different processes depending on the platform of your choice. Essentially, you will upload your content to the marketplace, turn it into an NFT, and wait for it to sell. It's very similar to Amazon and Etsy. If you already have a digital content portfolio, which you own the copyright, here is what you need to do next. Select your marketplace, mint the NFT, and link wallet. There are dozens of marketplaces for you to choose from. These includes Opera.c, Xe Marketplace, Rarible, Super Rare, and Mintable. Have a quick look at these marketplaces and select one that best suits your content. Your next step is to mint the NFT. In the simple terms, mining an NFT is the process of turning the digital file into a crypto collectible or a digital assets on the Ethereum blockchain. Though this may sound confusing, most of it, not all marketplaces will provide a step-by-step guide on minting your NFT right on their platform. Once you have selected the marketplace, you will have to link your funded cryptocurrency wallet. After that, you will upload your digital file and follow the process of your chosen marketplace. Each platform will have different processes and allow you to either sell the item as a one-off purchaser to earn royalties. List NFTs for sale. After listing it for sale, you will notice the marketplace will calculate gas fees. This is an Ethereum blockchain network fee to record the transaction. This fee will vary depending on how busy the network is. The best way to reduce this fee is to list your product during a non-peak hours, depending on the marketplace. NFTs can also be traded just like every other cryptocurrencies, but buying at a small price and selling at a convenient profit. This is the second option to make money with NFT. Selling NFT isn't just for the creators. Some entrepreneurs and investors utilize NFTs like stocks and profit by buying and selling them. If you have already purchased the collectible of NFTs and don't need them anymore, you can easily sell them with the same way you would if you were to create them yourself. The only step you will skip is the minting process. The trick to trading NFTs is when to sell them. The right time to sell an NFT will depend on what it is, why you bought it, and if there is any other interest in the item. Quick research on the internet and marketplace can help you determine this. You will also have to factor in the price appreciation or depreciation. Calculate your potential profit and loss by including addition costs like gas fees, marketplace listing fees, and royalties paid to the original owner. These fees will include ultimately reduce your final take home amount. For more complex NFT trading that requires in-depth knowledge, the cryptocurrency industry, you may want to consider consulting a professional as NFT. They are relatively new. You can scout freelance sites to hire someone who can help you with this. Conclusion: cryptocurrency isn't a quick get rich scheme, but it can surely make you rich over time. There are always high and lows in this technology world, but if you are determined enough, the tough times shouldn't break up.